You ever look at the sky-high valuations of today's tech companies and just wonder, is this for real? Well, the story of the dot-com bubble isn't just some dusty chapter in a finance textbook. No, it's a timeless lesson in tech, ambition, and honestly, the weird ways we humans act when we think we've found the next big thing. To really get a handle on today, we've got to understand what happened back then. So let's get into it. Okay, so this number, $13 billion, that was the valuation of the NFT marketplace OpenSea back in early 2022. It's one of those jaw-dropping numbers that feels both super exciting and maybe a little unsettling. It's the kind of thing that makes you ask a pretty big question.
Yeah, this is the one. Are we just watching a rerun? Is all the buzz around things like NFTs and AI a sign of a genuinely new era? Or are we just caught up in the same old pattern of hype and hope? To figure that out, we need to jump in the time machine.
So let's set the scene. We're going back to the late 1990s, the dot-com era. This was a time of just explosive optimism, and it's basically the perfect historical mirror for the kind of tech excitement we're seeing all around us today. The mid-90s were like a perfect storm for this kind of thing. The Cold War was over, the US economy was absolutely humming, interest rates were low, and, this is the big one, computers and the internet were finally moving out of the office and into our homes. It really felt like anything was possible, and this new digital frontier was where it was all happening. So the Fed chairman at the time, Alan Greenspan, comes out with this phrase, irrational exuberance, and it just perfectly nailed the mood. Investors were so swept up in the promise of the internet that the old rules, things like profits and revenue, they were pretty much just thrown out the window. A good story was worth more than a good balance sheet. But here's the thing. These huge speculative moments, they aren't just random fits of craziness. Economists have actually figured out that they follow a surprisingly predictable pattern. And it's all driven by some very basic, very human psychology. And this is the life cycle right here. It always starts with what they call a displacement, some game-changing new tech, like the internet. That kicks off the boom as prices start to climb and more people pile in. Then comes euphoria, the peak, where prices have totally detached from reality. But then the first cracks appear. That's distress. And it all leads to revulsion, which is just a fancy word for panic selling and the whole thing coming crashing down. And this is what's going on under the hood during those stages. You've got herding, which we all know as FOMO, the fear of missing out. People invest just because everyone else is. Then there's overconfidence, where everyone suddenly thinks they're a stock-picking genius who can't possibly lose. And finally, confirmation bias, which is like putting on blinders. You only look for news that confirms you're right, and you ignore all the warning signs telling you to get out. So, as that psychology flipped from euphoria to fear, well, the inevitable happened. The great dot-com party came to a very sudden and very brutal end. Just look at this timeline. The sheer speed of the rise and fall is breathtaking. The NASDAQ, which is full of tech stocks, went up 5 times over in just 4 years, peaking right here, March 10th, 2000. But then look, by October 2002, a little over 2 years later, it had lost a staggering 78% of its value. It was a complete and total wipeout. And the price tag for that collapse? An estimated $5 trillion in investor wealth. Just gone. Paper fortunes that took years to build vanished in months. To really get why, let's look at a few of the companies that were at the very center of it all. Ah, yes. Meet the poster child of the dot-com bust. Pets.com. The idea was simple, right? Sell pet supplies online. The problem? They were actually losing money on almost every single sale. In just 9 months, they burned through $147 million, mostly because, get this, shipping heavy bags of dog food across the country was wildly unprofitable. Who knew? Then you had Webvan, the online grocery delivery service. It was valued at $1.2 billion before it ever turned a profit. They took all this money and just went on a massive spending spree, expanding to 8 cities in 18 months. They built this huge, expensive infrastructure before they even proved the core idea could make money. Spoiler, it couldn't. And what about Boo.com? They wanted to sell high-end fashion online with this really slick, interactive website. It was a brilliant idea for 2010. But back in 1999, most of us were on painfully slow dial-up connections. The technology, the infrastructure just wasn't there to support their vision, and they burned through $135 million trying to build a future that just hadn't arrived yet. If you want one quote to sum up the whole insane vibe of the era, this is it. This came from a 20-something founder right after his company went public. The focus had shifted away from building real, sustainable businesses and toward just getting rich fast. And quotes like this really fueled the public's growing suspicion about what was really going on. Now, it is so easy to look back at the crash and just see a story of failure, of greed, of fortunes lost. But here's the twist. What came after the crash is what's truly fascinating. It wasn't just an ending. In a lot of ways, it was a new beginning. This slide says it all. The idea behind Pets.com wasn't actually wrong. It was just way too early. Now, fast forward to today, a company called Chewy.com doing the exact same thing is worth $13 billion. So what changed? Well, everything. Now we have the infrastructure, cloud computing, super efficient logistics, and pretty much everyone is online. The foundation that didn't exist in 2000 is now in place. And look at this. Even a true survivor, a company we all know, Amazon was not immune. Its stock got absolutely crushed, falling over 90% during the crash. But, and this is the key, because it had a fundamentally sound business model, it was able to weather that storm. And, well, you know the rest of the story. This brings us to a really smart concept from Amazon's own founder, Jeff Bezos. He talks about the difference between a purely destructive financial bubble and what he calls an industrial bubble. An industrial bubble is different because even after it pops, it leaves something incredibly valuable behind. And that is exactly what the dot-com bubble did. All those billions of dollars that were seemingly just torched on failed companies, they didn't just vanish into thin air. That money paid for the fiber optic cables, the massive data centers, and all the servers that became the literal foundation for the next wave of internet giants. Companies like YouTube, Facebook, and Netflix, they were all built on the ruins of the dot-com bust. So let's bring it all back to today. After this trip down memory lane, what does the story really teach us about how we should look at the tech trends of our own time? What's the big takeaway here? Well, the lessons are pretty crystal clear. You have to be wary of companies with huge valuations but no clear way to ever make a profit. Question that growth at all costs mindset that ignores basic business math. Like customer acquisition cost versus lifetime value. It's simple, really. Does it cost you more to get a customer than you'll ever make from them? If the answer is yes, that's a huge red flag. Watch out for media hype that drives a frenzy. And maybe most important of all, be incredibly skeptical anytime you hear those four most dangerous words in finance. This time, it's different. And that really leaves us with this final thought. The dot-com era proves that even in the middle of all the hype and all the failures, there are always companies quietly building real, lasting value. So the question isn't if another bubble will pop, it's whether we can learn from the past to spot the difference between the Pets.coms and the Amazons of our own generation.